Hey everyone, welcome back once again to our CA Foundation Business Economics series where we are discussing CA Foundation concepts in a most practical and quick manner. So, without wasting much time, let's get back to the video. Today we are covering chapter 7 of Public Finance, in which we will be covering unit 2, that's market failure and government intervention. So, here is a quick intro of it. So, a market failure occurs when the free market fails to allocate resources efficiently, leading to either overproduction or underproduction. Markets don't always lead to socially optimized outcomes, which creates the need for government intervention. This unit will explore how and why market fail and how the government can intervene to correct these failures. Here comes the concept of market failure. Market failure refers to situations where the market do not produce the ideal outcome predicted by economic theory. This can happen in two ways. First, complete market failure. That's when market fails to provide goods or services at all. And second, partial market failure. That's when market provides goods and service but at a wrong price or a wrong quantity. Example could be public transportation in rural areas may be an example of complete market failure where private firms don't provide services due to lack of profit. However, government provide buses in such region to fill the gap. Then you must be thinking, why does market fail? So here are some theories for it and with examples also. First, market power. Firms with significant market powers like monopolies can charge higher prices and restrict the output, leading to inefficiencies. A classic example could be a telecom company dominating a region can charge higher prices, exploiting consumers who have no alternatives. Then the second reason could be externalities. That's externalities occur when production or consumption of goods imposes cost. That's negative externality, or benefits positive externality on others, and these are not reflected in market prices. Example could be pollution from a factory affects the health of nearby residents, imposing cost on society that the factory doesn't bear. Similarly, planting trees in a public park offer environmental benefit to everyone. Third comes public goods. So public goods are non-extricable and non-rivalrous, meaning one person's consumption doesn't reduce availability for others. Private market fails to provide them because of the free rider problem. Example could be street lighting in a city benefits everyone and no one can be excluded from its use. This makes it unprofitable for private firms to provide, so the government has to step in or government steps in. Fourth, incomplete information. So markets function best when all parties have complete information, but often one party has more information than the other. Asymmetric problem information. Example, a used car dealer might have more information about the car condition than the buyer, leading to a less than optimal transaction. Then comes second topic, government intervention to correct these market failures. So first, minimizing the market power. So the government uses anti-monopoly laws and promotes competition to reduce the power of dominant firms. Example could be the Competition Act 2002 in India regulates anti-competitive prices or practices. Second, correcting externalities. So the government can impose taxes on activities that produce negative externalities like pollution or provide subsidies for positive externalities like education. Example, imposing a pollution tax on coal factories encourages them to reduce the emission. Third comes public good provisions. Since market doesn't provide public goods, the government steps in to provide them. Example include defense, road, and national park. Fourth, correcting information failures. So government mandate product labeling, accurate advertising, and public disclosures to ensure consumers make informed decisions. Example, in India, food items must display nutritional information to help consumers make healthier choices. Eh, One more practical example is pollution tax. Suppose a factory emits 100 units of pollution annually. So the government introduces a pollution tax of rupees 500 per unit of pollution to internalize the externalities. So here is a tabular for it. Pollution units, that's in first case it's 100 and in second case it's 80. So private cost is 50,000, but the tax is 50,000 in first case and 40,000 in second case. So the total cost will be 1 lakh for 100 units and 90,000 for 80 units. So after the tax, the factory may reduce pollution from 100 units to 80 units because of the increased cost benefiting society. So due to this tax factor, factory might reduce the pollution. Then comes government intervention in merit and demerit goods. So merit goods, these are socially benefit goods that may be underconsumed if left to the market, such as education and healthcare. The government provides subsidies to encourage consumption. Example, government subsidies for COVID-19 vaccination. Second comes demerit goods. So these are socially harmful goods like cigarettes and alcohol, which tends to be overconsumed. Government imposes taxes or restrict their sales to reduce consumption. Example could be higher GST rates on tobacco in India to discourage its consumption. Now comes to the end of the topic where we have MG extras, where we try to analyze and understand some of the concepts of this chapter in a practical manner using the above activities. So first MG extra is analyze public goods. So visit a local public park and note how it uses its non-rivalrous and non-excludables. Discuss how private firms may not have an incentive to provide such service without government's intervention. Second comes research government policies. So look up government incentives like the Pollution Control Board of India and their regulations on emission. So how does such intervention reduces negative externalities? Then comes the conclusion of this chapter. So market failures often necessitate government intervention to correct inefficiencies. Whether through taxes, subsidies, or direct provision of goods, the government plays a critical role in ensuring equitable distribution and optimal allocation of resources. By addressing issues like market power, externalities, and incomplete information, government policies help to maintain economic balance and public welfare. So that's it from a short and quick video. Till then, keep learning, keep growing, and keep enjoying. Bye bye.